Channel 10 Nelson, your community access television. Programming on this channel is made by local volunteers. If you would like to be a part of your community television, please call 354-4200 or write to Shaw Cable, 613 Ward Street, Nelson, B1L1T2.
Here we have somebody.
Good evening. This is It's Your Money, the first in a series where we talk about finances and what you can do to make yours work better for you. Banking, stock market, real estate, a variety of things. I'm your host, George Millar, and with me in today's program is Doug Turner. First of all, Doug, a little bit about yourself and why you would be on this particular program representing someone in the selling of stocks and bonds. What's your expertise in the area?
First of all, thank you for inviting me tonight. I work with Midland Walwyn in Nelson here. I'm a local resident and I've grown up here. So I do have some native background to Nelson. I feel it's a fundamental part in my business in Nelson, knowing people and helping them through the investment world. Midland Walwyn offers a variety of services, and as far as tonight goes, I hope that we can get involved with a variety of topics on investing through what we do in Midland.
Okay. I don't know whether I would say I'm going to try and represent the average viewer. Let me say I would represent the naive person in terms of stocks and bonds. And we hear all kinds of terms that maybe for some people are quite understandable because they know something about the market, but we go all the way from portfolio to stock exchanges that specialize. We hear stocks and bonds, what's the difference? Some are common shares, some are preferred. We've got blue chip. We talked about buying in futures. And then there's this term, play the stock market, as though it's kind of a game. And that scares some people. Can you give us a bit of a rundown on the general scene before we get into some specific questions?
It is a very broad topic, and in today's world it's becoming more and more broad. It's continually changing. There's new types of securities or investment means continually being brought into the investment world. So it is very crucial, actually, for someone who isn't interested in investing to either be as a full-time hobby, continually updating on the new services or products that are out there, or use someone that is in the field to help themselves get through those tough barriers to find the answers. I think it is vital for you to have some key link to being able to tap into a variety of knowledge. Computers are a big aid now. They can certainly get information out to people. And if you're unable to attach yourself to a computer or a network of data banks, then a business such as ours would be the way to go. It can certainly help you find out information and topics and so on. I believe that it would be of assistance to people to save themselves money on first basis, to do a little research before you actually come in and visit us. If you don't have a library or something like that at hand, then you could certainly drop in, see us, explain what you're interested in, and we could lead you in the right direction or give you some of the information that we already have.
Okay. Is the stock market for everyone? Is there an investment package that would be useful for somebody with limited funds to invest?
As far as is the stock market for everyone, everyone is an individual, and I think we certainly have to address that. Everyone is at a different stage in their life. They've just taken on a new mortgage. They've got a new family on the go. They're sending their kids to university. And different expenses at different people's times create individual scenarios each time. So actually, when we're working with someone, starting a new program with someone, every person has to be treated separately because there's no general terms that you can actually work from. Everyone is, again, in a scenario that is very individual to that person.
Okay. Is there any rule of thumb of X amount of, say, disposable income, or any guideline at all, or is it just simply a matter of what you have and how much you're prepared to put into this sort of thing?
There are a variety of guidelines. Some of the professionals would say 10% would be what you should save aside. Let's assume that you don't have any large debt, a mortgage or something like that you're dealing with. Some people take on a much more serious approach to investing and save more. John Templeton, for example, he's world-renowned as one of the largest mutual fund operators. He was saving 50 cents on every dollar, and a very strict guideline, but he's living in the Cayman Islands now, and he's certainly done well for himself, and he certainly helped a lot of people. As you read through, again, everybody would have a different nature to how much they could save, and you have to work out your guidelines. You have to really sit down and look at your picture, where you sit right now, and where you would like to be in the future, and then tailor some guidelines. Goal setting is very important to getting to those areas that you need to go. That's what we can help you do by setting down a financial picture of the snapshot of where you are now, where you would like to get, and then offer you the different means of getting there. Age is a very big point when it comes to investing and planning and so on. Guidelines have always said that a younger person can be a more aggressive person in investing. As you near retirement, safety becomes a very important factor. So you tailor it and structure it to your savings and to your age, let's say.
All right, let's get away from the individual for a moment and think in terms of, you mentioned aggressive investing and looking for safety. What would be some extremes in those? First of all, something that would be extremely safe, and then something that might be considered quite risky.
Again, safety or aggressiveness is really pertinent to the person that you're dealing with. Something very aggressive, let's say. A person could set down themselves a structured goal that they want to be a millionaire when they retire. So a younger person would allot, let's say if you're dealing with a portfolio 100%, you might allot 60% into an aggressive style, whether it's an equity mutual fund or investing in equities yourself, placing 40% into less risky situations. Canada Savings Bonds, Treasury bills, guaranteed investment certificates. Weighing this portfolio back and forth, getting into a safer position when somebody wants to or is nearing retirement, let's say, and safety becomes the major factor. You could shift your emphasis towards the safety, Treasury bills, guaranteed investment products, and so on.
All right. For the person who hasn't done very much, there may be a reluctance because they read, probably not have lived through at this point in time, although some of our viewers might have, the great crash of '29. There was a recent scare not very many years ago. The Vancouver Stock Exchange in particular seemed to be badly hit. And some people say, well, can I really trust this whole venture? What do you say if somebody says, maybe I have the money, maybe I can take the risk, but can I really be brave enough? What assurances do you give a person? I'm
trying to assume that you're generalizing around stock markets.
Yes, I am.
As far as these different scenarios or different historical trends that we've gone through, major crashes, 81, 82 was a severe downturn for the equity markets. 1987 was another bad mark in the equity markets. Each time they've occurred with different reasoning, depending on the economic cycle that we're in. The world positions globally, things are continually changing, and they affect the equity markets differently each time. Currently, major world events are undergoing. We've got a crisis in the Middle East. The Eastern Bloc countries are opening up and separating from the Russian domain. Russia's opening up its doors to the U.S. and the rest of the world. When we look at that sort of picture, we're looking at a much larger scale than just the economy of Canada, the economy of the U.S., Japanese economies. It leads you into a difficult situation when you can say, okay, if someone lived through a bad recession in 1981-82, which has been noted as one of our more severe recessions recently, they create different investing procedures, policies. Maybe, okay, I'm not going to get hurt that way again, and I'll protect myself by being more cautious. Your aggressive investors are still investing heavily in equities. They may be going after more sound equities, but they have structured themselves that they cannot get ahead by guaranteed products, so they are out there searching for the growth stock that would get them ahead and move them up in the world, creating a better retirement package for themselves. 1987 was a technical correction. Supposedly a series of events, computers were involved in creating this crash that occurred. Many professionals were heavily investing. Major corporations were investing in their own stock. They saw value at that time. When a crash occurred, you drop 20% off the price of a stock, they see value in that. And so they would be heavily investing into their own positions. Insider trading gives you keys to maybe what cycle and how positive a major corporation, its directors and board members believe it gives you a picture as to how sound they feel their company is and where it's going. 1987, for example, you were seeing heavy insider buying, which indicated a lot of movement could come back into the stock market, as in fact it did. We've come through a fantastic growth picture again. Right now, we've come, let's say, from August of '89 through a downturn. Up till April, fell 17% on our markets. It didn't occur in 1 or 2 days like in 1987, so it didn't create as much attention as in 1987. If you've been watching the pictures on the news, economic indicators, bankruptcies are up, real estate markets starting to fall. These indicators are out there that we actually are already in a bad position of possibly a recession. Statistically, they say when you go through 2 quarterly periods of downturn in earnings, that you are in fact in a recessionary state or close to it. Possibly we're at the bottom now and we're on our way back up. The bottom timing is very crucial to investing, and no one has actually worked out a formula for exact stock picking right now. Timing is of the essence when you're investing in stocks, let's say.
Okay, and it's, I suppose, to some extent, wisdom based on past experience and partly gut feeling or hunch that people move on when they try and decide if the thing is bottomed out or whatever.
Different stocks move at different times through a business cycle. Some say that we're in a 10-year cycles, 5-year cycles, 20-year cycles. Major mutual fund companies are talking much larger cycles.
Okay, can you give us an example of one that might be, say, a 5-year stock cycle?
Auto industries are very cyclical. Forest industries are very cyclical. And mining industries, as base metals, Cominco, for example, would be a very cyclical type of company. Depending on world demand, supply, you will see your earnings go up and down, and the stock price usually coordinates along with that. So if you're trying to make money in the stock market, timing in a particular cyclical type of company would be very important. If you bought at the top, you may have to wait 1 or 2 cycles to recover your position again if it dropped off and you bought at the top. Over time, statistically, it is proven that you do increase in value with the equity markets. They do outpace guaranteed products. Over time, your equity markets have proven themselves to continually go higher. You do have market corrections, but they do, over time, always go higher. And we've always seen that.
Okay, the term equity market itself may not be familiar to all of our viewers. What exactly constitutes an equity market?
Stock markets and equity markets, virtually the same thing, are structured by a number of public companies that issue stock to public people, to public investors, to corporations, and so on that would be interested in investing. It's a means of a public company raising funding to undergo an expansion phase or a new development that they may be requiring to expand and grow through business industry. Debt is another means that they can go, and that's how you create into the bond world. Junk bonds have been a heavy topic in the U.S. lately. Bad junk bonds have created a problem down there. The savings and loan industry, which are smaller banking situations, businesses down there, have gotten into a problem down there. And it is very interesting to see how this unravels and develops, how they'll get around it. It needs to be seen.
Okay. I alluded to the idea a while back that some stock exchanges seem to specialize in types of commodities or perhaps not commodities, but companies. Is there a particular trend that, say, the Toronto Exchange has as opposed to the Chicago one, for example? Or?
If you were to compare the Canadian exchanges, there are quite a few that most people probably aren't aware of. You can Vancouver, Alberta, Winnipeg, Montreal, Toronto. Everybody talks about the Toronto or the Vancouver markets, when in fact there are other markets out there. There's a variety of them. On each market, you have different securities that trade. You can get into commodities, base metals, different bonds. There's indexing, mutual funds, a variety of puts and calls, options, and so on and so on. It's a never-ending variety of products that are out there now. Each year we see new products that are brought onto the market and traded in a different manner. Quite often they're related to a different product that's already on the market. Recently we've seen a new mutual fund that's come on to the market, which is specifically targeted at an index, which is a grouping of stocks that trade on the market. So it collects dividends the same manner as if you were holding a portfolio of these stocks, and it moves accordingly to whatever the markets are doing.
Okay. We're going to take a short break here and allow for some graphics to come up on the screen, and then Doug Turner, my guest, and I will be right back. George Millar again with Doug Turner, and we've been talking about investments, primarily focusing on the stock market. Perhaps we should touch just briefly on mutual funds and then take a look at some other areas of investment that people make that maybe aren't quite so diversified, and yet leave people somewhat confused in themselves just because they are different from the stock market type of investment. So in terms of getting into some kind of a mutual program, I imagine there's high range, aggressive almost, and others that are kind of laid back and viewed as kind of safe for the small time player. And how does one go about determining that type of thing?
There are a huge number of mutual funds that are available now. They are a very good way for a beginning investor or a person that doesn't want to consume a lot of time investing, continually researching topics, companies, and so on. Your mutual funds have a group of professional investors that have certain guidelines that they follow, and it takes the worry out of your investment. And did you make the right decision? You leave that up to these professionals to actually do your investing for you. Your mutual funds now vary from 100% guaranteed types of mutual funds right up into the speculative, very high risk types of mutual funds, gold mutual funds, or a combination of gold and oil or something like that. Your mutual funds can vary depending on the person that is the actual investor and what sort of strategy they want to take. If it's a retired person, you could find a mutual fund for that person if they're looking for dividend income or a combination of interest income and dividend income. Takes the worry out of the continual search. This company mutual funds would find those for you. Let's take a young person that's an industry worker with high income, no family, no ties yet. This person could afford a little more aggressive position to get themselves ahead. Start a very aggressive investing program, putting themselves a good portion of their paychecks, let's say, into a regular investment program, hoping to attain good growth over the years and eventually shift off into a different type of investment program. There are mutual funds that could be used as just a savings program now. There are mutual funds that offer you not a guaranteed situation, but they have 100% secure situations, strictly earning interest, no volatility at all. In a situation like that, a person that's switching from a house and they need a place to put their funds for a short period of time could use a mutual fund like this for 2 or 3 months, moving it back out. In the meantime, they've earned the best interest on their money that they could. You can get into mutual funds for RSPs, retirement savings plans, and again, using a variety of mutual funds depending on the person. They are RSP eligible. Mutual funds have now come out with a retirement situation. It's an education savings plan for children that has been more flexible now than it was in the past. There are certain guidelines that you have to adhere to, like an RSP, but it gives you that opportunity to defer your taxes again, and giving you a savings plan for your children. It's a good policy to use for your children. Rather than just sticking the money into a savings account, you could possibly look at something like this.
Surely. There are some other areas of investment that perhaps some people don't stop to think of. One that comes to mind is even such things as when you're selling your home, working as a mortgage broker for the purchaser, a vendor mortgage, in other words. Are there other types of individual actions that a person can take where they, in fact, sort of control the investment that way?
As far as lending money to themselves for a mortgage or something like that, there are methods of doing that. You can use, in certain situations, your RSP and lend to yourself. Most people that come to us don't have a large enough RSP, and they feel that they could lend it to themselves at 1% or something like that. In fact, you actually have to adhere to the guidelines that are set out for most lending companies, lending at the going rates and so on. There are setting up guidelines and expenses that are involved too. So you have to go along with what is structured already.
Okay, we have touched briefly on the mutual fund, and to some extent, that's almost like having a group other than yourself worry about your portfolio, and you just put the money in, as opposed to you having your own portfolio where you kind of select what's going down and where the action is, and having to stay on top of it. Is that a correct?
Yeah, I've actually had one of our upper chairmen of our company say he feels very comfortable every night to go to bed, and he gets a great sleep because he wakes up in the morning hoping that his values have actually gone down so he can buy more cheaper. He doesn't worry about it at all. He's very happy, and you know, he has a sound program that he's set up for himself, and he feels very comfortable with where he'll be at in a few years.
And for the person who would come to a firm such as yours for advice, the thing is really wide open then, and it's a matter of that individual and their amount of money and their total lifestyle that has to be dealt with in terms of whether you would steer them into mutual funds or set up a portfolio that they would kind of almost co-operate with you, taking your advice but their decision involved in that type of thing.
It is a very step-by-step procedure. Initially, we really have to get to know you. Some people might feel that we're digging into their private matters, but how can you give them an honest opinion as to what they should do if they're hiding the fact that they have a large inheritance that's earning interest income? Their accountants know for sure, but if you're going to a financial advisor for advice, the cards should be on the table so that you can direct them down the right goals. Getting to know who the investor is a very important part to developing a balanced portfolio for yourself, and setting those guidelines, goals around that fact of getting to know who you are, what sort of goals you want to set, and how to get there, and offering you a variety of topics and products to go by. Hopefully along the way, if you are a beginner investor, we can educate you on different topics so that it makes it easier to communicate with your clients, and they can communicate with me on an easier basis. We feel more comfortable with the topics, and it gives you a better groundwork to work from as both of you get to know each other and know the topics better as you go. It's easier to pick up the phone, talk to somebody and say, this company's just come out with these earnings, and you will know what that means. Where at first, you would have to explain what earnings mean to a company and so on. When a person comes to us, we offer a variety of products, and quite often you can start off with a very safe, non-committal situation to lead yourself into something. Develop the program as you go. From guaranteed products to treasury bills, Canada savings bonds. And depending on the type of person that you are, we would switch you around into different products, you know, with what we agree to, setting up a program.
When a person presents himself to an agent such as yourself, what tends to be the majority? Is there a tendency to try and oversell the value to you, or do they tend to hide their debt load to some extent?
But people will always talk about their good dealings in the past. They made a good deal or made a good purchase on a stock and did profit very substantially from a trade that they did. You never hear about the bad topics until you really get to know that person.
Yes.
I believe anyone would be in that situation to hide the bad points. You don't want to reveal your silliness of the past. You would prefer to highlight on the good points, which is good. It's a positive nature.
Sure.
Again, getting to know that person, if you can find out where they've made their mistakes in the past, you're not treading on any hot water to go into the new products that they could possibly do better. And,
Okay, for a beginning investor, do firms such as your own have any kind of programs where they could begin to learn things, or is it always just a matter of come in, talk to us, maybe buy a book that researches the market, or what's the best way to go about it?
Midland Walwyn is a very large company. I said that we're now the largest retail brokerage company in Canada. We offer a variety of services. Out of our head office in Toronto, we have a large research team that continually investigate into different situations and do offer suggestions for your clients. We then pass on that information to you. If you are looking on a particular topic, then we can offer you a variety of informational booklets. There's continual updating. If your economics is your bag, then we can offer you some booklets on economics, and so on. There's a variety of RSP informational booklets, bonds, common stocks, and they get in depth to the extent that you would like to see it. We can always offer, hopefully your broker is continually staying updated with what news is out there, and it could direct you in the guidelines to local bookstores that are holding good financial books or different topics that you in particular would be interested in.
One question that is going to seem like it's right off the wall, considering what we have been talking about, but we've got a new deal coming down in the federal finance system, the GST. Is that going to impinge in any particular way on the stock market or other investment procedures?
I think it will affect Canada as a whole. The complete outcome of how the GST will work is not known. There's always some unforeseen circumstance that they never looked at. I personally don't believe that they've looked at all the avenues and all the effects that it will have down the road. It's like our free trade agreement. We're not really seeing the full effects of that yet because it's implemented over time. I think you'll see that same procedure with the GST and so on, other than it's going to employ a lot of people at the start to try and keep track of it all. I think it'll create a nightmare for accountants and so on. The ramifications are unlimited as of yet.
Okay, and one other question related to taxes. Do I have to be a big player in investments before I can find what people commonly refer to as a tax shelter by it?
No, not necessarily. I believe most people can benefit from some tax sheltered situation, an RSP or so on. The government has been eliminating a number of different avenues that we can use as tax shelters and so on, more so targeted at the higher income investor. As a smaller investor, our RSPs are indicating to us that down the road maybe the government won't be able to support us, and this is why they're continuing to allow us to make contributions to RSP. They're saying, put some money away now, get a savings plan built up, because if down the road you're self-employed, you've got your own business, you may not have that money down there to retire on, and you'll continue to work and until you're very old. And, it gets hard on you. It'd be nice to retire at 50 and be very comfortable. I think there is some validity to planning with an RSP for that year down the road when we all want to retire.
Okay, if there were any particular advice, sort of capsulated, that you would be able to give our viewers in terms of getting into some kind of investment program if they don't have any other than perhaps company pension plan and CPP, that type of thing, is there anything that you would say to them? There's a very brief summation related to investment.
I think the best thing that I could advise someone to do is start now. Educate yourself as much as you can. Read as much as you can. Continually search, because it's like someone who's trying to quit smoking. The more that they try to quit, the better they're doing for themselves. Find a broker or someone that can assist you in information. It should become a hobby, a lifelong hobby for yourself. You're the only one who's going to benefit from it. So if you can, improve your situation to learning on investing, it's only benefiting yourself. Start now. That's the best thing to do. There's a variety of things out there, and the sooner you get started, the more you'll know about it. So start now. That's the best
So
advice I could say.
That's number one advice, is
Yeah.
get started now. Okay, great. I'm sure there are a whole range of other things we can go into, Doug, but I think we'll stop there for tonight. And thanks very much for being with us on this first edition of It's Your Money. And perhaps we'll have you join us again, look at some other aspects of controlling your finances down the road. Thanks again.
Thank you very much, George. It's been a pleasure being here.
It's your host, George Miller. It's Your Money. Stay with us for others in this series. Good night.